All right, let's get right into it. Welcome to this high-level threat briefing explainer. Today, we're unpacking a massive structural dynamic that's literally reshaping modern finance: the systemic vulnerabilities introduced by hyper-leveraged, automated liquidation engines. Look, if you're a risk manager, a quant, or someone responsible for deploying capital at scale, getting a firm grip on these mechanics isn't just some academic theory. It is absolutely fundamental to surviving the market. To help guard that institutional capital, here's our roadmap for today. We'll start with the anatomy of a wipeout. Then we'll cover maintenance margins and triggers, systemic cascading liquidations, evaluating market contagion risk, and we'll wrap up by looking at the autonomous machine elite. Starting right off with Section 1, the anatomy of a wipeout and the disappearance of liquidity. For a second, I want you to completely forget what you know about traditional trading halts or frantic phone calls to your prime brokers. Just imagine sitting at your desk, eyes glued to your screens, watching as $100 million of market liquidity completely vanishes from the order book. Just vaporized. And it's gone in under 60 seconds. This right here perfectly illustrates the lethal structural vulnerability of perpetual trading. In these hyper-fast environments, human reflexes simply don't cut it. There's just no way you can click a mouse fast enough to save your portfolio when liquidity evaporates this violently.
And this highlights a core trade-off we grapple with every single day. Leverage is the ultimate double-edged sword, right? On one hand, you get massive capital efficiency, the undeniable lure of controlling huge, market-moving positions with barely any upfront cash. But on the flip side, systemic danger. Because the exact same structure that grants you that leverage exposes you to ruthless structural collapse when automated execution engines fire off during adverse market moves. Capital efficiency, when pushed to the absolute brink, inherently becomes systemic fragility.
Okay, moving right along to Section 2, maintenance margins and triggers, focusing on the protocol's code.
So if we focus purely on the cold, hard code, the absolute crucial concept to grasp here is the maintenance margin. Look, in traditional finance, a margin call might get you an urgent email or maybe a brief grace period to wire over some extra funds. But in the automated environments we're analyzing today, the maintenance margin acts as a hard-coded tripwire for your collateral. It is the strict, absolute minimum amount you have to maintain to keep a leverage position open.
And honestly, here is where the math gets brutal. In a lot of cases, this threshold sits at less than 5% of the total position value. The very microsecond, and I mean microsecond, that threshold is breached, you do not get a warning text. The protocol instantly seizes control of your assets.
Which leads us directly into Section 3, systemic cascading liquidations and the domino effect. Now, what happens when these individual, localized margin calls spread across an entire ecosystem? We get a cascading liquidation. You might know it colloquially as a massive long or short squeeze, but structurally, it's a chain reaction. Forced liquidations mechanically shove prices further down, or up in the case of a short squeeze, which then instantly triggers the next wave of liquidations. It's a literal domino effect that can crush an entire market structure in an absolute flash. As risk managers dealing with systemic financial impacts, you absolutely have to account for this exact mechanical sequence. So let's walk through it. Step 1, the price drops just a bit against a highly leveraged position. Step 2, that sub 5% maintenance margin is breached. Step 3, the protocol's automated engine takes over and ruthlessly dumps the assets onto the open market to protect the system. But here's the massive systemic kicker in Step 4. That massive, unfeeling sell-off absorbs all the buy-side liquidity, pushing the price even lower, which immediately trips the maintenance margin of the next trader down the line. The automated sell orders inherently trigger further liquidations. It feeds on itself.
And the really stark systemic reality here? Human emotion is completely removed from the equation. There is no pause button, there's no room for negotiation, and there is zero human empathy once those execution engines take the wheel. The code just does exactly what it was written to do, systematically clearing the books.
Let's shift gears to Section 4, evaluating market contagion risk and actually surviving the volatility.
Because understanding the wipeout is really only half the job, right? Mitigating it is where you earn your keep. Your systemic risk models have to predict the breaking point before the cascade even begins, and that requires incredibly strict quantitative metrics. You need to implement real-time volatility indexing so you know exactly how thin the ice is at any given second. You've got to monitor collateral health ratios on a microsecond basis. On top of that, you have to critically evaluate the integrity of the protocol's insurance funds. Like, if the cascade moves faster than the liquidator can actually sell the assets, who eats that bad debt?
If you aren't aggressively stress testing your systemic risk models against these specific automated flash crash scenarios, you are basically flying blind right into a hurricane. Bringing us to our final section, Section 5, the autonomous machine elite and the future of risk.
Surviving volatility is merely the baseline when we're staring down this new paradigm. Just look at the contrast here. On one side, you have manual human reflexes. We're slow, we get emotional, we're easily overwhelmed by data, and we're literally just sitting there clicking buttons on a screen. On the other side, automated liquidation engines. They are ruthless, operating with millisecond precision, fully autonomous, and built entirely on agentic infrastructure. Trying to manually trade through these cascading loops is totally a relic of the past. It is literally bringing a knife to a drone fight.
The real heavy hitters out there aren't just reacting to these flash crashes. They are actively anticipating them. What we're witnessing right now is the rise of agentic infrastructure, autonomous bots executing insanely complex strategies without any human input, completely dominating on-chain powerhouses. These actors have built an entire layer of automated software infrastructure to manage risk and deploy massive capital simultaneously. They are the new machine elite, operating completely seamlessly within the hostile territory of cascading liquidations.
So, as you sit down to review your collateral health models today, and as you deeply assess the systemic financial impacts of your portfolio's leverage, I want to leave you with one final, absolutely critical question. Is your risk infrastructure truly ready for the autonomous elite? Can your systems actually withstand the millisecond precision of tomorrow's execution engines, or are you still relying on human reflexes in an increasingly automated world? Thank you so much for joining me for this explainer. I highly recommend stress testing those quantitative metrics before the next cascade hits. Stay sharp out there.